on the sidelines of the JPMorgan India Investor Summit. And we're having a lot of conversations here. And well, the one I'm having right now is to do with the technology space in India specifically. And for that, I'm in conversation with Ankur Rudra. He is the executive director here at JPMorgan, and he heads APAC telecommunications research as well as India TMT. Ankur, thank you so much for joining us.
Thank you for having us, Agam.
Right. So, Ankur, I'm going to get off the mark with the question on Indian IT. A lot of business, uncertainty in terms of the environment. We've seen a little bit of delay in a lot of deals coming through. My question really is here that what does it mean for visibility? In fact, I was going through one of your reports. You said that a lot of clients are now resorting to monthly budgets. What does that mean for the outlook for the sector right now?
Yeah, I think the outlook for the Indian IT services sector has been a bit cloudy for the last 6 to 9 months. And I think what's happening is, one, on the technology budget side for CY24 has been very tight, like you mentioned. In many cases, clients decide budgets on a monthly basis. So if there was a budget decided at the beginning of the year and it's not spent like in month 1, month 2, or the first quarter or so, it doesn't come back the following month. You don't get it back. You sort of start from the bottoms, and hence sort of it's tough for companies to see an upside later in the year. And essentially what's happening is there are two tracks of spending. There is the discretionary spending track. There is the keep the lights on a cost spending track. The discretionary spending track has been rather weak, and we continue to see cancellation. So we've seen a lot of companies commenting how things have not bottomed out in the last quarter. So those remain challenges for visibility for fiscal 24 for sure. And there are no clear signs, how the next financial year will play out also.
Right. Ankur, a few weeks ago, you had mentioned that a lot of these companies are reverting to their long-term growth averages of slightly higher single-digit growth. The question in here is that what does that mean for valuations? Because earlier in this calendar year, we saw a lot of companies cut their guidance coming through, and then we saw a sharp correction. But at the moment, we've seen a rise in share prices for a lot of these companies. So, on a scale, where do you gauge the valuations?
No, I think it's an interesting question. Back in June, we had highlighted that this year is likely to turn out very different versus earlier expectations. And we had said that, a lot of our channel checks suggest that growth is unlikely to be more than 0 to 5%. And in the event, that's what's begun to play out, right? Last quarter commentary, I think from almost every company, doused any expectations of a growth pickup. However, like you said, the results have not been reflected in the numbers. So while the numbers have been rather weak, the commentary has been still relatively bleak. The company share prices have done well. And I think what our analysis and research shows in our conversations with investors, I think there are 3 or 4 factors driving that. One, there's a consistent investor fatigue with the underperformance of the sector. The sector has been underperforming for since February of last year. Right. So it's over 18 months of underperformance, and I think investors have taken a call that let's look through the near-term weakness. F24, it's fine, it doesn't matter. So Q1 was bad. I think there's a broad expectations. Q2 will not be significantly better. So people will look through this, and the focus has shifted to F25. So there's a hope that F25 is a lot better. Secondly, I think what we're also seeing is to an extent there's an expectation that the macro in the US has potentially improved. The inflation print so far has been coming lower than expected. The GDP has been holding up. This is mainly US GDP, right? And also the expectation of dodging a recession in the US, I think that's risen a lot. So the consensus expectation baking in is that there probably won't be a recession next year. Now, that's an open question, what happens? And I think the call investors are taking is for IT services, it's a late cyclical sector. And if the macro is really improving, maybe they will see this later. And hence, they're sort of moving ahead of what these companies are seeing and saying. Third is we're also hearing from a range of investors, global tech investors and India domestic investors, that they have portfolio construction problems. Everything in India has risen up a lot. Valuations are expensive. What do you buy? That's leaving a lack of alternatives. And we hear this from global tech investors also, by the way. When they look at US tech, so US software, semiconductors, internet, they've all rallied a lot, 60-70% up this year. IT looks relative value. And there's been a bunch of large deals that have been announced in the last few months. So that's making people a bit more optimistic. So when we look at all of these things, what we think is we still stick to the belief that long-term growth is 5 to 8%. And on that metric, we are actually growing below or at par with pre-COVID multiples. Sector is trading at a much higher level compared to that. So which is what makes us very less constructive about the sector. So which is why we remain underweight. We are waiting for if there's a turning point, if growth accelerates, and maybe this makes sense. But at the moment, the share prices seem to bake in, double-digit growth at least for the next 2 years.
Right. Well, so, based on that, you're underweight in all IT companies, if I'm not mistaken. What are the underlying factors that you'd like to see improve before you start re-rating some of these companies?
Sure. So I think what we are looking for and hoping for, and number one, is if there's any kind of change in enterprise spending, technology spending intentions. So enterprise tech spend has been weak, especially in sectors like banking, which has been significantly under pressure, led by a lot of the global banks. The TMT sector, so technology, internet companies, software companies, semiconductor companies, telecom companies, they've all been cutting budgets very aggressively. And and in the rest of the economy also, US companies especially, there's been tighter budgets. So if there's any change in trend there, and typically one doesn't have to wait for IT services companies to look for that. There is a long value chain in enterprise tech. There is enterprise hardware companies which see this first, followed by software and SaaS companies, and finally consulting and then IT services. We've seen this play in the reverse in the last 1.5 years. So we're waiting for early convincing signs of that happening. So I think that's sort of one of the key factors we're waiting for, or if the macro convincingly improves. So those are the two main things we'll look for to see if there's a case for better performance of these companies.
Sure. Right. So Ankur, I'm going to shift focus to telecommunications. Once again, you're underweight on the two telecommunication companies that you guys track. I know that there are high 5G commitments when it comes to investments. It's not like it's going to be easy given the current environment to go ahead with tariff hikes. My question really is then relative to the rest of the markets, when you turn positive on some of these companies?
So I think the interesting thing in India has been we've seen one of the most aggressive 5G rollouts in the world. Probably faster than the US. We just spoke to Akhil, from Bharti, just a few hours ago, and I think Akhil Gupta was highlighting from Bharti that we've probably had the fastest except China, right? So we added about 330,000 5G base stations over the course of this year, and that's more rapid than what's happened in the US. The problem is that monetization is not happening, right? Nowhere in the world have telcos been able to really monetize the 5G capex investments, and any kind of delay in tariff recovery or price repair, basically has a negative impact on ROICs for the industry. So that's what makes us, a bit more, worried about the industry, which is what keeps us, on the underweight side of things. So we are waiting for, the capex intensity to recede. Once we see capex going away, and our analysis for Asia Pacific telcos also have suggested that markets which are on the which have gone beyond the 5G peak, that's where we start seeing capex undershooting, which is a great time to own telcos. So I think that's maybe one thing. Second is if there's any kind of improvement on the ARPU side, that will make us potentially more positive. If there's any kind of new sources of revenue monetization, fixed wireless, maybe we've seen a huge amount of fixed wireless launches in the last one month, both from both the main operators. And if that is successful, if it genuinely creates a new opportunity, those things are what we'll really watch for. So I mean, eventually it's ROICs. If you see any kind of improvement, chances of improvement on ROIC, that probably will make us more constructive.
Right. Ankur, with the inability of at least one of these players to not be able to, in fact, put in investments in 5G, are we heading for an effective duopoly?
It's an interesting question, and absolutely important from a market structure perspective. We've seen the market structure becoming let's say a 2.5 to 3 odd player market with two very strong operators, one operator which is probably is struggling a bit, and there's an SOE as well in India. And I think what is difficult to say, because there's multiple ways this can play out, the market structure. It depends on policy. It depends on ability to raise tariffs for the industry, and there can potentially be changes in the market structure driven by regulations or intervention or investor participation in the sector. So all of that is potentially possible, but I think it's sort of early to necessarily say if it's a duopoly or not. But effectively, there are primarily just a couple very strong, well-funded operators, and in telecom is an industry where you definitely need funding, which is critical for next generation investment. And of course, the 5G is one thing which, and in many markets in Asia, we believe in many markets across Asia Pacific, 5G actually has enforced consolidation, where, to an extent in Malaysia, in Taiwan, in Thailand, in Singapore. So we've definitely seen across markets this enforcement of consolidation happening, where you've gone from 5 to 3 or 3 to 2. So it can definitely drive some sort of restructuring or potentially nationalization of assets, which we've seen in other markets.
Right. All right, Ankur. And a final question then on some of the consumer-facing technology companies that you have coverage on, and you're relatively positive for a change. Your outlook here.
Sure. So we've been quite optimistic about the internet or tech companies, the consumer tech companies in India most of this year, and I think these companies have done rather well. I think what's really worked for them in the last 6 to 12 months is they're all given very clear paths for profit break even,
Right.
and to their credit, they have achieved it. So we've seen that come through, and one of the drivers for that has been a significant amount of streamlining of focus. I think to an extent, gone are the days where companies were try to invest in multiple adjacencies,
Right.
and I think companies have sort of been focused on core business adjacencies which are not easily monetizable. I think they've been to an extent sidelined.
Right.
I think that's helped the companies, and there's also been definitely rationalization of consumer basically CAC charges, customer acquisition costs, marketing costs. We've also seen these companies grow, and with growth, we've seen platform economics play out. We've seen operating leverage coming through. So I think all of that is done really well, and as a result, Indian tech companies, internet companies are one of the best performing stocks in the internet sector globally.
Yeah.
So I think that's really helped them, and we remain constructive. We think we will potentially keep seeing operating leverage play out.
Right.
Platform economics play out. This is a market which should see medium to long term, solid growth, which will help many of these companies.
Right. Well, Ankur Rudra, that's all I have for you. Thank you so much for your time and taking us through your views on the many sectors that you track. That's the outlook on the Indian IT space, the Indian telecommunication space, and of course, a lot of these consumer-facing technology companies as well, which are looking up. But we're signing out for now. There's lots more lined up. So stay tuned to BQ Prime, and we'll keep bringing you more.